Hello everyone, welcome to today's video. And in today's video, I had some new positions that I added to the portfolio. And in preparing to add those positions, I went ahead and compared 5 different companies. These are different stocks that I've had on my radar, but until now I hadn't done enough research in them to actually make a move on them. So in this video, I actually went through all of these stocks' latest earning reports. I ran some valuations, as well as going through their 10K, mostly item one business, the business section, as well as the MD&A for these companies. So the companies I was looking at is, as you can see on screen right here, Celsius Holdings. I was also looking at Salesforce, ServiceNow, FICO, and American Express. So just starting off right at the beginning with Celsius, this stock year to date has been getting hit pretty, I'd say pretty decently down. Let's see, year to date down about 36%. And of course, Salesforce and ServiceNow have been lumped in with a lot of those SaaS names, and they have been having their stock price go down with this whole SaaS apocalypse thing going south. As you can see, ServiceNow sitting at about a 30% decline year to date as well. And Salesforce about 29% as well. If we're looking at FICO year to date, I believe this one was about the same, 24. So not as much, but still decent amount down from year to date. And then if we're looking at American Express, down 16%. So all these stocks have been getting hit. So right off the bat, I went ahead and I threw some different metrics that I was personally looking at to help narrow down which ones I wanted to look at and which ones I wanted to focus on. So I'll just go ahead and get this right off the bat and let you know which ones I did end up choosing, because I actually bought 3 of these companies. I decided to invest in Celsius, ServiceNow, and Salesforce. And if you were just wondering which positions I added, those are the 3 positions. At the end of the video, I'll actually go ahead and show the actual moves I made in terms of how many shares of each I bought. But if that's all you cared about, just right there, just for anybody who cares about that. And now I'll kind of go in depth on my reasoning for picking those and not picking FICO and American Express, or why I actually decided to invest the amount I invested in these separate companies. So first off, let's talk about American Express. So American Express, very, very good moat on the company. Obviously, it's the American Express credit card. They collect fees from that, and then also the processing of transactions for credit cards charge as well. Very good business model. Reason personally I didn't invest in this one is I didn't like the current ratio at a 0.31, which that's current assets over current liabilities. It's kind of a liquidity metric to show much how much the company would be able to handle its current liabilities with the current assets on hand. So think, well, for them it wouldn't be inventory, but think like cash equivalents, any prepaids would go into that valuation and equation right there. So I didn't like that was low. I typically, when I'm investing in a company, I at least want it over 1 or very near 1. I'll make exceptions sometimes, but a 0.31 I didn't really like, especially for a company as mature as American Express. Other thing, the return on invested capital, when I was looking at it at a 5.57%, I was personally expecting a higher ROIC, especially for this being a more mature business model, where when the business models are more mature, I prefer that ROIC to be higher. So even though if you look over here at Celsius, its ROIC isn't that much higher either. Celsius is also a relatively new company and it has a lot of growth going. So I factor that in as well. So with American Express being a slower growth company, or a more mature company, I should say, and having that lower ROIC, I don't like. And then also its growth rates are pretty much just in line with what the market's growing at. So it's pretty much how the economy doing. It's very tied to that. Not my favorite. And then when I ran these base projections down here, which all these base projections, I went into more depth with projections on these other 3 stocks that I actually decided to invest in. But these initial projections, I just kind of based it off what average analyst estimates were, and I just kind of plugged those in to give me an idea of around if average analyst expectations were to occur, I could expect for returns, just to get like a initial picture before I put too much time into researching. And for American Express, I was getting an 11.68%, which is still a market beating return, but I'd still prefer that to be a little higher. I'd like it to be closer to 15%. If I'm risking my capital in an individual stock, I need it to be giving me a higher return than the market. I don't want the market return. And that doesn't really give me that much of a leeway or a margin of safety at 11.68%. Not as much as I'd like. So for that reason, that's why I didn't invest in American Express. It could be a decent moneymaker over the years. I'm not saying it can. And obviously take all this analysis and stuff and my valuations, take it all with a grain of salt. I am not a fortune teller. These stock prices could do they can do way different than whatever I'm projecting, or they can grow much higher or grow much less. Some of these can get disrupted. Again, these are all just what the valuations I am running based on what I think their growth rates are going to be, based on what I've looked into the company, but I could be wrong on it. And as investors, that's why we kind of diversify our portfolio. We have multiple positions. We're basically just playing calculated odds across multiple positions. And sometimes we're going to get it right. Sometimes we're going to get it wrong. And sometimes we're going to get it really wrong and we're going to invest in something that just is a money sinker. And sometimes we're going to get it really right, and a company where maybe we had our projections were actually way lower and the company outperforms. And then those exceeded returns, something like a Palantir, or like I have a ATI as well. That's when you get those like 10x, 15x type stocks that really carry for the poorer performers in your portfolio. So just like with anything, just building that portfolio where I have as much chance for these calculated odds to play out in my favor. But enough little rant on there. That's why I didn't invest in American Express. Now with FICO, of course, these are the mortgage lenders. They do a bunch of the credit scores. And this one really there wasn't anything blatantly wrong. Like, really good current ratio. Their margins are very impressive. That ROIC is extremely high. By all metrics, the company looks great. The initial projections were great as well. And there really wasn't anything wrong with this. This is just a matter of, I only have so much capital to deploy. And if I had more capital, I'd probably be adding this one as well as with the other three. But whenever I was looking at the other three stocks, being ServiceNow, Celsius, and Salesforce, just reading through their annual report and going through their earnings, I believe they have higher potential with my projections and a higher chance to give me a larger return. But like I'm saying, this is just a matter of not having infinite capital, because if I could, I'd be owning FICO as well. So nothing wrong with this one. I think this one could be a decent moneymaker. There's a chance this one could even outperform some of these other positions I'm starting in. That's a very real possibility. But me personally, just from what I've read and making my decision on it, I preferred Salesforce and ServiceNow as well as Celsius. So with that out of the way of why those two I didn't invest in, let's go ahead and start with Celsius. So Celsius, this one, very simple. This one is just giving me more exposure to kind of, I guess, a consumer, you could think of it. Obviously, Celsius, they own the Alani brand, they own Rockstar, and they own the Celsius brand. So this is just selling energy drinks, and caffeine is very addicting. I should know. I drink a ton of caffeine between my pre-workout, energy drinks, stuff like that. Caffeine is just a naturally very addicting product. It's basically, it literally is just a legal drug. But anyways, regardless of that, they have really good brands, really good growth. And the main thing is, the reason I was fine investing into this one is kind of a plethora of reasons, but the main thing is I actually do like their product. I've tried their energy drinks and I do like them. I do like that there's more natural flavors. Something that's been annoying me, this is kind of going more on a tangent, but something that's been annoying me more in the, I guess, energy space you'd call it, is I find there's way too many artificial flavors and it really annoys me. Like my favorite pre-workout is Gorilla Mode by Gorilla Mind. I've used that one since if any of y'all ever follow Derek from More Plates More Dates, I've been using that pre-workout since he first launched it, when he made that first like whole 2 hour breakdown of all his ingredients list and the original formula. So quite a while I've been using this pre-workout. And one of the things that's bugged me about his company going forward is they have so many artificial flavors. Like they have like this stupid rainbow sherbet. They have this like bombsicle flavor, cotton candy grape, different things like that. And obviously there's some people who enjoy that, and that's fine, but the thing that's annoyed me is they've gotten rid of a lot of the natural, more natural flavors, such as they used to have like a mango peach lemonade that was really good. They used to have they had a, what was it? It was a cherry blackout one that was pretty decent as well. And I'm trying to remember what the other one was. Basically, a lot of their natural flavors they kind of gotten rid of in favor of going more of this route of like very, very sweet, artificial flavored, almost like candy tasting. And I just personally don't like it. And what I like about Celsius is they have a bunch of natural flavors. They have like a watermelon lemonade that's really good. They have an orange flavored one. They have like a peach flavored one. It just, for me, it psychologically it feels like, okay, this could be more healthy because obviously it tastes like fruit, but then also I just prefer these natural flavors rather than having my energy drink taste like a glorified like children's candy. That's just me personally. So I actually do like their product for that reason. Now, the other thing, they have a really strong current ratio, which is great, especially for a high growth company like this. They have plenty of current assets to cover any liabilities that are coming up on the next year, as well as their growth rates are just very impressive. As you can see, the trailing 12-month net income growth was a 41%. We have right here revenue growth of 123%. So if we go ahead and go over to this tab, which these numbers are completely pulled from their latest earnings, I just have it broken out over here and shifted it over here so I can get kind of a percent change, which we can see 138% growth in revenue year over year for Q1. But the main thing I want to focus over here is on this section where I have kind of my projections going on it. So just to kind of give a basis of my projections, what I did here is I broke out their revenue between their three different brands, Celsius, Alani, Rockstar. I got a weighted average growth rate based on the percentage of revenue that each one of these make up. Now, one thing I do want to point out is, funny enough, Celsius is actually no longer the largest component of their revenue, which is crazy because you'd think the Celsius brand, obviously, that's the largest. But Alani has actually recently taken over. Another very impressive thing, so while Celsius was growing about 5.6% year on year for their actual revenue growth, in this brand, Alani was putting up 60% while also being a larger portion of the actual revenue, which is pretty insane. So they have this new energy product being Alani that's more geared towards the female consumer, is what it's more geared towards, that is growing rapidly while still being at a larger size than their main Celsius brand, which is just going to be a great thing, especially if they're able to reignite growth from Celsius, and they'll be able to pull those two growth levers that will help going forward in the future, which I think they will be able to do. They were talking about on the earnings call that they were still clearing through some inventory, which is why they're having kind of the slower growth rates on the main, the legacy Celsius brand, as well as they've actually said how they've started having traction with the new fizz-free product from Celsius, where they're releasing a new fizz-free energy drink, which is basically just Celsius without the carbonation, essentially. That's also been accelerating growth. So if that takes off as well, maybe we can see some reignition of the main Celsius brand, maybe back to double digits, low double digits, maybe like a 10% growth rate, and that could be helpful. So I basically took a weighted average growth rate of those. I gave about a 4% margin lift just to account for revenue going to net income. I expect more margin improvements, especially getting just economies of scale and just getting more efficiencies as they integrate the Alani and Rockstar brands, because as these are acquisitions, as they're able to integrate them more and more, they should be able to cut costs down as they're able to kind of utilize both the distribution of the Celsius brand. They should be able to ideally improve their margins and cut down on some costs from just that and between administrative stuff as well. Now, if you look at the trailing PE and the forward PE, there's a pretty big divergence between those two, with the trailing PE at a 70, the forward PE at a 17.86. So to kind of factor this in, what I went ahead and did is, when I was running these projections as a starting point, I was using next year's expected net income as a starting point. And then to account for this, obviously I cut down the growth rate, which is why my normalized growth rate for current year is a 16.57% that you're seeing in the base case. Even though over here with the margin lift, you should see net income of around 30%. I cut it down pretty considerably to factor in that, as well as if growth does tend to slow over the coming years. Even with that, so I have them running at about a 16.57% net income growth rate, a PE on the low end of a 28 and a high to a 34. If you're thinking, okay, is that fair? Is that fair for that? Well, if I'm looking at other companies in the drink space, if you're looking at like a median PE for 5 years for something like a Monster, which is obviously a direct competitor with Celsius, they're trading at a 37. So these energy drinks are usually typically able to command somewhere in the higher range of 30. Even a median price of free cash flow, same thing, of about a 38. Celsius over the past 5 years, obviously they've had extreme profitability growth, but at a 112. But obviously that's a little extreme just because of their higher growth. But if we're looking at Monster, it's able to command this, even though the net income on a 5-year CAGR has only been about 6%, so not even that insane. And even if the revenue 12%, and they're still able to command a 37 as a median, whereas Celsius is growing at 81% as their 5-year CAGR on revenue, and their net income at a 66%, so way exceeding this. So you can make an argument they'd actually deserve to be much higher, given their net income is over double what Monster was putting up in the past 5. But still, I'm trying to be more conservative on my base case. And then obviously I have Coca-Cola, Dr. Pepper, and Pepsi, some other drink competitors, not direct energy competitors, but there's not a lot of direct energy competitors to compare to that are actually on the scale of Celsius. So I threw in some of these legacy drinks. But even you can see in the drink space, even these legacy brands, which don't have very impressive growth, they're still able to command mid-20s PE. So with Celsius having a higher growth rate, I can see them commanding a higher valuation, which is why in my base case I'm running at a 28 to a 34. So if we're running through my base case, I have a low fair value of $49.26. Oh, also something to factor in here, I'm using a 15% discount rate, meaning if you were to buy at this price and my assumptions occurred right here on the low end, you'd get a 15% return, which is pretty decent. And then I factored in a 1.5% dilution. Anyways, back over here. So on my low projections at a 28 PE, 16.5% growth rate, low fair value of $49.26, a low future stock price of $99, that gives me a compounded annual growth rate at 26.85%. On the higher end, we have a PE of 34, high fair value of 59, high stock price of 120, and a high compounded annual growth rate of 31.88%. So for that reason, as you can see all the rest of the assumptions I made right there if you want to see the other CAGRs, but not going to waste time just explaining that over and over. So as you can see with the projections, even in my bear case, I'm still getting double-digit CAGR above 15%, which is why I've been so happy to pick this up. So as you can see, I'm looking to pick up shares under $42, which the stock price is well below that. I think on Friday it closed out in the 30s, but earlier in the week when I was able to pick it up, it was actually in the 28s. Yeah, closed out Friday at 30.12. So I still believe I have plenty of time to just be accumulating shares over time, just building my position out as much as I can. So with that being said, let's go ahead and move on to the next one. We'll start with Salesforce, and then we'll move on to ServiceNow. Now, with Salesforce, the easiest way I can explain their business model is they're obviously a SaaS company, but they're basically a CRM. They basically run the CRM management for a lot of large enterprises. So, customer relationship management. The easiest way you can think of this is there's a lot of different data points when keeping track of customers as a large company. For example, you might have someone clicking on a website and generating a lead. You'd obviously want to keep track of that. There might be spreadsheets to keep track of that you have. There could be, if you're invoicing a customer, you could be invoicing that in the ERP system, which is they're basically their accounting software they're using. So if they're using like an SAP or an Oracle, you could make an invoice in there. And all this data is kind of just scattered across these different softwares the company will be using, or even just sending out leads or emails to customers. You want to keep track of what you've done, and all of this data is very disorganized and just spread across. Salesforce kind of sits on top of all of this, and you feed all your data from these different sources into Salesforce, and Salesforce compiles this data and puts it in a very easy to view format while also running data analytics. So you could so let's say you have some leads you're putting in from people who looked at the website. They could be potential customers, they could be potential sales. You're plugging it in over here in Salesforce. Salesforce is keeping track of it, and now it's able to make an accurate prediction of what next quarter's revenue is going to be, or next quarter's sales, for example. Other things could be if a customer, let's say one I saw a lot of is if there's some customer support needs and a customer is maybe requesting a refund, or they have some sort of issue where they call customer support, the representative helping them with customer support will be able to pull up their profile in the Salesforce dashboard, and they'll be able to see, okay, this customer has purchased this, this, and this. This is the last time they purchased. They complained about this issue maybe a month ago, and just kind of more information that's very easily seen and consolidated. So every section of that data is very easily viewable for anybody who needs it. As well as, like I said, with the data analytics, helping that as well. Another use case that I was seeing is maybe to help grow sales. They look through that whole list of customers that may be in the system and say, okay, this person hasn't bought, let's say if there was like a company selling winter coats, they haven't bought in a winter coat since last year. The Salesforce could say, okay, let's go ahead and send them out an ad with a 20% discount to try and get them pulled back in this year to come buy a coat with us. Now, something that is an actual tailwind that they're talking about a lot on the earnings call, and they were discussing a lot just during the latest earnings, I should say, is just with the whole agent force and the agentic AI agents that they're planning to use that could really start to accelerate revenue growth to a very high level. So for anyone who doesn't know, basically they have these AI agents that could basically do tasks for you. So like I was saying with, let's say, the lead on the website, previously you might have to have someone go in and manually input that into the Salesforce system. Now with an AI agent, it can detect that there's a potential lead being entered into on the website by a customer, and that AI agent itself can go in and start inputting the data automatically, limiting the amount of manual data entry you have to do. At the same time, it also could start reading the data analytics. So instead of initially having someone in either IT or maybe someone in the company have to go in and analyze this data analytics and think, okay, what's the strategy we're going to use from reading this data? The AI agent can start going in, reading the data analytics, and put together a plan saying, okay, here's what we should likely do for X, Y, and Z, and kind of just help the company decide, so they're able to make decisions on this stuff much quicker and much more rapidly. And with this one, the company is starting to charge more for use cases, which is something I've heard a lot of these SaaS companies talk about. So in terms of this, instead of just charging for, originally they were charging for actual seats for people actually using the software, or the licenses, which they called seats. Instead, now they're starting to charge for the actual uses. So these are like AI generative tokens or credits that the companies are using. And as they use more and more, that's when they pay Salesforce for the amount they're using. So even if they're losing seats, they could still continue to accelerate their revenue growth going forward, just in terms of just the token usage and charging for that token usage for the AI capabilities of these agents, which I think could ultimately be a tailwind and be a re-accelerator of growth. So with that being said, I ran a base case of net income growth, have them going to 18%. I have a low PE of 23 to 27, so I have a bit of re-rating going on in here. As you can see, currently the trailing PE is sitting at a 19, forward PE of 13, but I do think in this base case, if what I'm believing is going to plays out, where the AI agents start accelerating revenue growth again, I think the market's going to re-rate that multiple back up, which is why I have a 23 to a 27. And then in the past, these SaaS companies have been given much higher of a premium. Just right now with the SaaS apocalypse thing going on, of course, we've seen those multiples compress considerably. But if you look at like the median PE for a bunch of these other companies, for example, like Salesforce used to be trading at a median PE of 56, Oracle at a 31, Adobe at a 39, ServiceNow at a 148, and currently it's trading at a forward PE of 13, an under 20 trailing PE. So I believe it's going to re-rate, but I'm not giving it the same premium as it was commanding in the past, either way, just to be a little more conservative with it. So even here, re-rating to a 23 to a 27, that gives me a low fair value of a 232.99, a high fair value of 273.89, low stock price in the future of 459, high stock price of 542. That gives me a CAGR in the range of 22%, just about to 26%, which is pretty decent. Again, discount rate I used was 15%. This one, I was implementing a 2% share buyback as the company continues to buy shares as of the latest quarter, which is why I'm factoring that in as well. So with this one, just going forward, I'm going ahead and picking up shares of this one under 215. Now you may be saying or wondering, okay, your base case has this low fair value of a 232. Why am I picking up under 215? Main thing, because what if I'm wrong on those agentic AI agents and they don't actually end up accelerating revenue growth as much as I think they are? Which I think they will, but there's always a chance I could be wrong, which is why I'm putting in an additional margin of safety by just saying, okay, I'm just going to take about $15 more off this current lower end of my base case and just buy it under that. And while the stock price is still depressed and I'm able to pick that up, I'm going to be buying that as aggressive as I can be buying. All right, guys, and moving on, we'll go ahead and move over to ServiceNow. Now, ServiceNow, if we go ahead, funny enough, if we go ahead and look at the stock price again, we showed the year to date earlier. It's currently sitting at about $102. Trailing PE of this one is 59, a forward PE of 23. So again, expecting some decent growth on this one. And the best way I can describe this business model, so ServiceNow, the basic way I can describe them is if Salesforce was more of the actual consolidation of all the customer relationship management information, such as for generating sales and keeping track of all the customers and more like external things to drive revenue and growth, ServiceNow is the same thing, but more on the back end. So you'll see this mainly in companies, like even my company uses it for IT tickets, where if you have an IT problem, you send in an IT ticket, and ServiceNow is managing kind of the back end to get all those tickets and send wherever the request needs to go to automatically. That's normally where the company starts, and normally they start transitioning it into other administrative areas of the company, such as HR, and if they have a legal department, for example. So this basically creates more operational efficiencies. For example, in the terms of that IT ticket, ServiceNow can also watch and see if there's maybe any potential breaches, and if it notices any breaches, it can notify the proper person so they can get that addressed in a quick, timely fashion, I should say. And maybe if someone's hiring and you're doing the onboarding process, when you're hiring, you need to get these like W-9 forms. There's this department that might need information. Now payroll's going to need information. It can automatically set that chain in event and start sending out the proper requests from every department automatically. So where I kind of describe Salesforce as like, okay, maybe they have all this information from these different systems on the sales side or from the websites, customer leads, and it consolidates it. You can think of ServiceNow as kind of sitting on top of the stack, but for more of the back end administrative systems. So it's consolidating all the information between, let's say, IT, the payroll department, HR, etc. You kind of get the picture with that one. And it's just kind of consolidating it. So most companies, from what I'm looking, will actually use both products. They'll use ServiceNow and Salesforce as well. However, in the conference call from Salesforce, they did mention that they did take some customers away from ServiceNow from these agentic agents, but then also ServiceNow seemed like it was taking some back from Salesforce. So they're kind of starting to mesh in and cross into each other's territories, which is fine. I think at the end of the day, both services can win and both companies can do well at the same time. But the reason I'm investing in both is because with ServiceNow, I get kind of that back end, and with Salesforce, I'm getting more of the front end. And while I don't know which one's going to outgrow the other one or if one's going to outpace the other one, by doing this strategy where I'm buying both of them, I'm able to get exposure to both ends, which I do like. And then personally, I do like ServiceNow. I'll say I like ServiceNow a bit more. Trade off with ServiceNow is, as you can see, it's a little more richly priced, where Salesforce is trading cheaper. But ServiceNow has more growth. Also, I do think the fact that it's more in the whole back end of the company, driving some of those operational efficiencies, gives it a little more diversification in my portfolio and a little more staying power, if that makes sense. Because the one thing I was worried about with Salesforce is, okay, how much are they overlapping with Zeta, where Zeta could potentially start taking their customer base, which Zeta's another big holding of mine. But when I was looking at that one, so that was that marketing segment for Salesforce with a relatively small amount of their revenue. I want to say it was under 15% of where their total revenue was coming from. But still, just to stay kind of diversified on that, that's why I'm investing in both of them. And that's how I'm kind of looking at it, at least from my perspective, and how I'm feeling comfortable with that in my portfolio. So, with that being said, again, I went ahead and pulled in the latest quarterly numbers. One thing I also didn't like as much is just that current ratio and the quick ratio, which this quick ratio, I believe I left a note right here, but I took out inventories and prepaids and the deferred cost to calculate this quick ratio. So it's the current assets less these accounts right here divided by the current liabilities. I'd prefer to be a little higher, but still not too big a concern for me. And as well, again, this one is a little high, a little priced a little higher, but also it's expected to have more growth. So there's that as well. Anyways, so most of the actual, what should I say, the other competitors I was looking at the same as with Salesforce, as they kind of operate in the same space. Now, ServiceNow has always commanded a PE quite a bit higher than the other ones. As you can see, their median PE over the 5 years is the highest at a 148. Obviously, I don't want to use that, especially not in my base case. But with my base case, I am going ahead and targeting a 19% growth CAGR right there. I also did adjust for the next year's earnings and then ran my growth rate off of that, similar to what I did with Salesforce in that Salesforce example. But running that at a 19% net income growth rate, a PE between 33 and 38, I have a low fair value of 158, a high fair value of 182, low stock price of 318 to 366. That's a 27 to a 30% CAGR if these assumptions were to occur. Now, with this one, I'm trying to buy under 125 is where I'm shooting to buy from, which I was actually getting worried this week because I picked it up and legitimately right after picking it up, the stock was up 10%. If you look on the 1 week, yeah, we just saw the stock price kind of quickly flash forward in 1 day all the way up almost 10% up to 109. And then it started to give back some of those gains towards the end of the week, and now it's down to 102, which I'm more happy with because I was getting worried for a second that I wouldn't be able to fully build out my position. But the price did come back down, which I'm actually happy with because I am looking to pick up this one for quite a bit of time. Also, similarly to Salesforce, they also do have kind of the same thing going on with those agentic AI agents. So that same bull case I was talking about with Salesforce, where if they accelerate the use cases with the agentic AI agents, they can do the same thing on the ServiceNow side. So while they might lose seats and licenses to ServiceNow due to needing less people because these AI agents are operating more efficiently. So let's say maybe a job in IT used to need 3 people to run it. Now with the AI agentic agents, you only need 1 person to oversee it. So you're losing those other 2 seats. They're making up for it by charging for the actual usage and the token usage, similarly to what Salesforce is doing. And you can actually hear this if you listen to the conference call. They talk about this quite a bit, to where they're shifting to where they're still charging, obviously, their monthly subscription, still their subscription service, but then they're stacking on any of the efficiency gains. They're starting to charge for the usage and the use cases, which I think could be a net tailwind to the earnings growth over time. So that's what I'm factoring in there. Now, going forward, what we can go ahead and look at, so I gave you these 3 companies that I did start positioned in. I can go ahead and show you the moves I made during the week. So give me 1 second while I pull that up. All right. And we are back. So going for my moves I made during the week. So as for the new positions I started, what I'm starting to do. So while I do like ServiceNow and I do like Salesforce, I like both these companies. They kind of are both in that SaaS space. Again, Salesforce being more on the front end, trying to drive that revenue growth, while ServiceNow is more automating the back end of companies, more of the administrative tasks to drive operational efficiency to improve margins with companies over time. I want to get exposure to both of them. And while I do like both of them, and I'm not sure which one's going to ultimately win in the end, or which one's going to outperform, I could say, because more than likely both of them are going to be winners with this, where both their stock prices could both appreciate. But as for which one's going to appreciate the most, I personally don't know. So what I'm doing is I'm buying these in a 1-to-1 ratio, where for every dollar I'm putting into Salesforce, I'm putting $1 into ServiceNow, just building the position almost as like a consolidated position in my portfolio, where these two are always going to be getting the same amount inputted into them. Obviously, the amounts of them are going to differ as the stock performance differs over time, but in terms of the actual capital I'm putting into these positions, I'm going to be putting in the same amount. So I did $75 worth of Salesforce. I bought that at $175.51. That was about 0.43 shares. Bought that on May 18th, which I believe was Monday. I believe all these moves I made on Monday. Now, ServiceNow, I also bought $75. That was 0.75 shares. And that was at $99.48. So I was able to get it before that price spiked, which is great, because that as soon as that price spiked up like 10%, it was back down within the end of the week. So luckily I was able to get that, and I'm hoping the stock price stays around the hundreds. Obviously my buy range is under 125, but if I can get it lower, I'd obviously like to build my position at lower amounts. Now, Celsius, I bought 4 shares of Celsius at $29.89. Again, this is one I'm going to continue to be looking to buy. And then, of course, we have the 2 positions that I've still been building out for. We'll start with SoFi. SoFi, I bought 3 shares at $15.57. This one, even though this isn't on the topic of this video, this price has been going through more of a pullback recently. So that's actually pretty good, because I'm still building out my position in SoFi, so I'll continue picking up shares. Zeta has actually seen some more momentum. This week it was actually up pretty decently, which I'll go ahead and pull that up in a second right now. But I picked up 5 shares at $18.13. $90.63 is the total price I paid for those shares. And of course, if you saw my last video I just made where I updated my projections on Zeta, my price target right now, my base case for Zeta is sitting at like around $80, which is why I am still buying the stock extremely heavy in my portfolio. Or not as heavy as when I was buying extremely heavy, but I'm still even continuing to add, even though it's grown into a much larger position in my portfolio. Now, just before we end the video, I can go ahead and show, if we're looking at SoFi on the week, because this one has been seeing some weakness recently, which on the week, if we go here to here, about flat for the week. But as you can see, it was downtrending for a bit, all the way down to $15, and then it started to recover towards the end of the week. And if we look at Zeta, it was actually quite the opposite, where we are looking at about 3% up on the week. And Zeta has been a bit of a roller coaster, but past month up about 7%. We can see on that one day where there was also that spike that just looked like a spike in SAS and then it pulled down, because if we look, Zeta also spiked quite big on that day. But regardless, because Zeta stock price has been going up and it is a larger position in my portfolio, my plan going forward, I'm still going to be buying Zeta, but whereas over here I was buying about $50 and $90, I'm probably going to flip the proportion on these. So I'll probably be buying more like 2 or 3 shares of Zeta, and then for the difference of that, make up for it by buying extra shares, another 2 shares or so of SoFi going in. So shooting more for like a $70, $80 range of SoFi, and then ship this down to around $50. Celsius, I'm still going to be looking to buy around $125, around that, and still 150 split between these two new SAS positions I have made in the portfolio. So with that being said, thank everyone for watching this video. And I know I have some people I've seen, I'm pretty sure there's a recurring viewer, because I always see like this one consistent view that's always showing up across the channel. So I do notice. Thank you for watching the video. I really appreciate I really appreciate it. I'm just trying to make these videos because I do enjoy talking about stocks and talking about my different investments, and I don't have a lot of time to talk about it going forward. I don't come into many, you know, it's not like much that I'm able to talk about this sort of stuff, because not a lot of people understand this or are too interested. Stocks aren't the most interesting thing for most people. And so this gives me an outlet to kind of talk about this. And also it really does help me improve, I feel, as an investor, because doing these research for these videos makes me more disciplined. I have to think more about why I'm really making these moves, so I can better explain myself, not only for your audience, for the audiences and everyone watching this video, but even for myself. If I want to come back and reference it, I have to really think through my logic and make sure I can make it clear and make it understandable of why I'm making the moves I am making my portfolio. So I just thank everyone from watching. And if there's any stocks or any questions you have on any of these investments or something I am not considering, please don't hesitate. Let me know in the comments, or let me know if there's any positions or anything you want me to look at, and I'll go ahead and take a look. I'm always open to seeing new stock ideas. But thank you so much, and I'll see you all in the next video.